Today's the start of a new week. It's Monday, and we're going to start off the week with a nice little learning lesson. We're going to be talking about Stoch RSI, also known as just Stoch. Some people refer to it, like myself, as the Stokes. Just sounds cooler. Not a real name. So we're going to go over how we can use that in trading and what the common pitfalls of traders are when they use the Stoch. So let's pop into it. So the Stoch indicator, I already have it added here down at the bottom. It is a RSI indicator, but you'll notice a few differences. One, there are two lines here instead of the RSI, which just has one. And these two lines are known as K, being the blue line here, and D, being the orange line. Oops. You can see that K and D, these lines on the Stoch, range from 0 to 100, and they're very reactive. They move up and down very quickly. And what this is an attempt to cut out some of the delay in RSI. However, I find most traders don't use this indicator correctly. Unfortunately, they think it's similar to an RSI when in fact it's actually used differently. So the difference is you can think of Stoch RSI and RSI being different kind of in the way that moving averages and exponential moving averages are different. So they're all lagging indicators. However, similar to moving averages and exponential moving averages, Stoch RSI attempts to find quicker changes. So the pitfalls that I see that traders most commonly fall victim to when using the Stokes is they're trying to use it, one, on a short time frame, or two, they're trying to use it to find overbought or oversold conditions in the market. They're attempting to use it to take positions against the trends, and this is not advisable in my opinion. The Stoch RSI is really used. It's really used to find continuation in a trend. So by itself, if you're just looking at a chart with just Stoch RSI, it's not valuable. And in fact, it's going to give you a lot of false signals. Stoch has a good amount of noise in it because of its design to more quickly react to market changes. You're going to get false signal after false signal after false signal. So what you need to do, this is the way I use it. I'm sure there's other ways out there, whatever, you know, if something works for you, that's cool. But this is the way I've used it, and I find it actually very accurate. So what I've done here first is I've added this middle line. I go down to the Stoch indicator and make it big, grab a horizontal line. If you double click it and go to coordinates, just type in 50. You want it right at the 50 mark. So now that we have that, this band or this line is going to serve to give us, I guess, a confirmation of a crossover. So Stoch above 50, we're going to treat as bullish conditions and below as bearish. And you can see it comes preset already with two lines. They're kind of hard to see here, but one at 80 and one at 20, and that is similar to RSI. RSI defaults are 70-30, but you guys have commonly seen me set those to 80-20 because I think they work better in crypto specifically. So if Stoch isn't going to help us find reversals, what are we using it for? You'll see on this chart I have a few vertical lines here. Those are going to be examples I'm going to go through. But you'll also notice this yellow dotted line. And on this channel, I always use moving averages. But when I have an exponential moving average, I always signify that with a dotted line. So you can see here this yellow dotted. I always use yellow as a 50. We are on the daily chart, so this is the 50 exponential moving average, and we're going to use that for this example and explanation to judge the trend. So if price is above the 50 EMA, exponential moving average, we are going to say that the trend is bullish. If price is below the 50 EMA, we're going to say that the trend is bearish. And so you can see, just as of last night, we're underneath it, but it won't matter for this example. So let's see for my example. So what we're going to be looking for is, we're not going to be looking for positions to take against the trend. We're actually going to be looking for positions to take with the trend. So above 50 EMA, we're going to be looking for signals from our Stoch to go long. And below the 50 EMA, we're going to be looking for signals on our Stoch to go short. It's pretty simple. The 50 EMA here on the daily, I just chose really whatever, this isn't standard. This is just what I do. Certainly you could use a regular moving average or a different setting, but I wouldn't advise using a Stoch under the daily. So I have the daily up. And if we look back, let's see, our first example is the 19th of July. So we were above the 50 exponential moving average. And if we look down here on our Stoch, we see that we got a cross of the K and D up. And that's what we're going to be looking for. We're going to be looking for crosses up or down. This was a cross up because the K crossed the D. The D is the signal line, and the K is the faster reacting line. So the blue is always going to cross the orange. And in the reverse, we're also going to be looking for times where the blue crosses down over the orange. So when trend is above the 50 exponential moving average, sorry, I might have been a little, this is kind of complicated in words, might have gotten a little confusing there. So when price is above the 50 EMA, above this yellow dotted, we're going to be looking for crosses up above the orange. And when price is below the 50 EMA, we're going to be looking for crosses down. So the first example, July 19th, we see a cross up of the K and D, and we see price above the 50 EMA, and that was a signal to go long if we're using just Stoch basically. And we see that we got some continuation. If we go back again, May 26th, same thing, we're above the 50 EMA. We see the cross up on our Stoch, signal to go long, caught it again. Go back again to April 22nd. Same setup here. Price was below the 50, so we didn't have that signal yet. But you see right here, price moves above the 50 EMA, and simultaneously we have a cross up again, and we see continuation. So far we have 3 great examples. But we're going to look back even farther, and we're going to see bearish examples. So March 3rd, price is below, trending below the 50 EMA. We see a cross down, and it caught the move again. 25th of January, price is above the 50 EMA. We see the cross up, signal to go long. Back even just a few days before, January 14th, price is above. We see a cross up. We have a small rally, so it caught it again. 8th of December, price is below the 50 EMA. We see a cross down, signal to go short. So it's really simple. I'm sure there's other ways to use this. I'm not a huge fan of the Stoch simply because it's really full of false signals if you're not reading it correctly. And on lower time frames, I find almost no value in it because you can see it's so volatile. It goes from 100 to 0 to 100 to 0 over and over again. And the movement from 100 to 0 or 0 to 100 doesn't really mean anything by itself in a bubble. For me, as I'm using this example, the 50 EMA, which is really just a simple, it's visual. We can see it in this explanation, but it's really all about the trend. If the trend is up, you're looking for the Stoch to cross up, even if it's already at like 100. You see down here, in this example, Stoch is all the way at 85, it crosses down, then crosses up to 95 and crosses down. On RSI, when we see that, we would be thinking, oh, this is maybe a lower high or something. That's not really what we're looking for. What we're looking for here is really just any cross that agrees with our trend. This indicator, in my opinion, does not help you find counter positions. So if the trend's down, Stoch isn't going to help you find potential rally spots. And I find that that's really what people use it for. They think that, okay, Stoch is at 0, it's crossing up, that's bullish. That's only bullish if the trend is already bullish. It doesn't matter as much where it crosses, whether it crosses at the top of the bands or bottom. We're really just looking for those crosses in relation to the trend. So we're going to look at a few more. November 29th, price is under our 50 EMA. And we see the cross down again, and we see price move down. That wasn't a huge move, but Stoch still caught it. November 11th, we see Stoch cross down while we're below the trend. Got it. This one right here, October 22nd, price is below trend. We see a cross down. So that one was a little, not the greatest signal, but still did catch it. You can see there's plenty of examples. As long as you're paying attention to the trend, on a higher time frame, Stoch can give you signals. Can give you pretty reliable, nothing's 100%, pretty reliable signals. We see a bunch of examples here, but almost every time I've heard someone talk about this indicator, they're not talking about the trend. It can be used in conjunction with other indicators like the MACD, I would suggest, to find divergences. The Stoch can give you perhaps an agreeing signal with something MACD is saying, and give you a disagreeing signal. You can use that as evidence. So it can be used in combination with other indicators. But standalone, I think it's next to useless. If you're going to jump on the 1 hour and use, like, oh, we're at the top here, we crossed down. That's just gonna, like, it might work. You see it worked here, even though the trend's above this 1 hour. This worked, but you're gonna get a lot of these signals. Like, this one's lucky that did play out, but you're gonna find that you're gonna get these, I'm gonna call it noise. You're gonna see a lot of crossing and a lot of movement on the Stoch, but it's not gonna consistently play out, especially on the lower time frames. So it's really about measuring where's the trend and what is Stoch telling us, and it can help us take position. I hope that helped everybody understand a little bit more about Stoch. There's definitely more to it, but I find that this is the easiest way to give everybody kind of a 101 how to use the Stoch indicator. Shavant.